Yvonne. Thank you so much for that. Meantime, of course, we're watching the NASDAQ because it's taking another big hit with big tech leading the sell-off. Now investors are waiting to hear from the Fed, which starts its two-day meeting today. Here now, Constellation Research CEO Ray Wang and Market Gauge Group Managing Director Michelle Schneider. Ray, I want to go ahead and start with you. Let's talk about inflation for a moment because that's one of the worries that the market has right now. The administration, President Biden, they've essentially passed the buck off to Jerome Powell. They're saying raise rates, do it now. We don't care what happens to the stock market, but you can see it starts to worry investors.
Yeah, inflation's playing a long-term hit, and it's a short-term hit. Every investor is trying to figure out what that means to the PE ratios and in terms of what every tech stock is going to, how they're going to perform. But there are a set of tech stocks that are actually going to do better than others. We see that in the enterprise cloud plays. These are the areas that are going to survive this. But right now, it's a readjustment. We're in correction territory, and everybody's worried about what that might mean. So is it going to be a 10% correction, a 20% correction, or where we are at this moment where we're sitting at near 52-week lows? And so I think that's the calculus and the refactoring everyone's making at the moment. Yeah,
you look at these big swings, Michelle, and we've seen 1,000-point intraday moves. We haven't seen that in a long time, and it starts to spook the markets as well. So, you know, the fear starts to build, and then it kind of grows and builds on top of each other. You think about the Fed and the options that it has. It could say, we are going to pull the trigger. We are going to raise rates, despite of how the market reacts. They tried that under Donald Trump. Jerome Powell tried it, and eventually he had to give in because the market just was not taking it well.
True, but I don't think that's going to happen necessarily this time, because in 2018 we were in a very different place. It was before COVID, it was before the labor issues, and it was before the fact that we had inflation running so hot. So right now the Fed has to really play both sides of the fence. I think we will hear that the rate rises are on the table starting with March. However, we have to keep perspective. The market may not like it, and that's because we've had cheap money. Companies that have had terrible balance sheets for years were able to borrow at nothing, and that's changing. But on the other hand, we even if we go to 0.5% or 0.75% in terms of our rates by the end of this year, it's still so historically low, especially if you compare it to 40 years ago when inflation was running hot and rates were much, much higher.
No, I hear you. And actually, I think back to the last scenario that we were just talking about. I mean, the fundamentals of the economy, Ray, the fundamentals of the economy at the time, as Michelle points out, pre-COVID were so much stronger. You could make the case that actually the market could handle 0.5 point or even a full point of rate, increases over the course of a few months. This time, however, we've got a little bit of a different dynamic because of COVID, because of the administration's spending policies. That's really what sent the inflation running real hot now.
That's part of it, but I actually think once we get past it, I think what we'll see in March is probably a 50 basis hike. That's going to help. Once that's done, people are going to reset their expectations. They're going to come back, they'll look at big tech and say, here's where the growth is. These are the companies that are still actually proving it. We're waiting for the Microsoft numbers today as well to show and hopefully stabilize where the NASDAQ's going to be, and people have an idea where the floor might be. There's still going to be a lot of volatility. I mean, you're looking at a VIX in the mid-30s, and that is, we haven't seen that for a while.
Yeah, no, we haven't. And Michelle, I want to come back to you. This notion that essentially big corporations across the country are price gouging, whether it be the grocers, whether it be big oil, whether it be the meat producers. I mean, it's difficult to make that argument because so many prices are essentially set by underlying commodity prices. And it's not the corporations that set the prices, it's market dynamics.
Well, if you go back to the history of how commodities trading got started, they were a hedge for farmers in the corn market. And that's exactly what happened, is that over the last several years, a lot of the raw material prices got so cheap, food especially got so cheap. So what they did was they cut back production. So then you get a perfect storm like what we've just had with lots of stimulus and COVID and demand going crazy with supply chain issues. And voila, you have what's happening right now, which is everybody was caught really basically with their pants down in terms of how much supply there was to begin with. And this is why commodities go through a cycle, and we have to cycle through in order to be able to meet demand. We have to be able to get more goods out, and these things, you don't just magically appear. You've got to grow stuff.
Right.
You've got to mine stuff. So yeah, you can blame whomever you want, but it's really been a perfect storm.
All right. Great to see you both. We'll see you in a little bit.